So basically, we'll be running through, I'll be taking financial accounting for this diet. Welcome back to another diet. So quickly, let's just run through the course guide. We are way behind schedule. Our week 1 was supposed to start with introduction to financial accounting, whereby we'll be looking at the meaning of financial accounting, the scope of financial accounting, users of financial information, objective of financial accounting, as well as functions of financial accounting and accounting standards and their regulatory framework. And week 2 being today, we'll be looking at accounting concept and convention, which is the conceptual framework, as well as the characteristics of the financial information, basis of accounting, and capital and revenue expenditure. So let's start. Meaning of accounting. Meaning of accounting. Now, it is necessary for every business that wants to thrive in the nearest future to keep adequate records. And in the process of this, keeping this adequate record, birth accounting. Before we go further diversing into the cost content accounting, let us look at what a business is. Now, business is used in various contexts. It could refer to as an economic process as well as an entity that engage in that process. There is no universal definition of business, but there are some possible definitions that includes the following. One of it is that business is an economic system in which goods and services are exchanged for one another or for a consideration called money. Business entity, that is, having understood what business is, that refers to as an economic system in which goods and services are exchanged for one another for a consideration, or which is called money, or it could be other means of exchange. What is now business entity? A business entity is a commercial organization that operates with the goal of making profits. A business entity, which is a company, I wouldn't call it a company, but for a business to become an entity, it means that it must be a commercial organization. What they mean by commercial organization is buying and selling is going to take place, exchange of goods and services will take place, and economic activity will take place, but with a goal of making profit. You will agree with me today that no business runs with the goal of not making profit, except if that business is a non-governmental organization. And even if it's a non-governmental organization, they will still fulfill some stakeholders' needs. A business is an integrated set of activity and assets that can be conducted and managed to provide returns to investors or other owners. Why I'm taking my time to go through this line by line, it's because of the nature of your exams. Your exams comes in MCQs and theory. Like I think 40 questions for the MCQs, then 60 questions for the theory. That's why I'm taking my time to go through the course module line by line. So just follow me as we flow. So a business is an organization or an enterprise entity engaged in commercial activity, industrial or professional activity. These are what we call businesses. So businesses could be a commercial system that has to do with exchange for goods and goods, service for service. It could also mean that they are integrated set of activities, assets that can be conducted and managed to provide returns to the investor, or it could be an organization or enterprise engaged in commercial, industrial, or professional activity. What are the characteristics of business? Now, one of the characteristics is that it primarily exists to make profits. All business exists to make profit. 2, is that business earn profits by supplying goods and services. So if they don't supply goods and service, if they don't supply goods, they must provide service to an individual, which is the customer. So that is one of the characteristics. That is, they earn profits by supplying goods or service to customer. Now, business that supplies goods might either produce them or purchase them. So it's a two-way thing. They are either retailer or the manufacturer. They are either retailer or wholesaler or the manufacturer. So it's either they produce these goods, that they make them, or they purchase them, which is one of the characteristics. Two is that profit is the reward for taking risks. There's this saying that says the higher the risks, the higher the profit. So business profits, the reward is for taking risks. So when there is higher risks, then you expect a higher return. And lastly, the profit of a business belongs to the owner, who may receive a share of the profit periodically. So another characteristic is that the proceeds or the profit from the business belongs to the owner. It doesn't belong to any other person, but the owner. But the owner. Now we'll go to types of businesses. Types of businesses. So there are three main types of businesses, which we are familiar with. We have who we call the sole proprietor. We have a partnership. We have company. That's it could be limited liability. It could be limited by guarantee, or it could be an unlimited liability company. Let us see who a sole trader is. A sole trader, sole, single one trader. So a sole proprietorship is a business owned and managed by one person, one individual. So it's considered that's a form of business considered to be a sole trader. So what are the features of this sole trader? One of the features of a sole trader is that the owners and the business are legally the same entity. That is a very key feature. That is, the owner of this business are the same person. They are not different. They are just the same person. Another one is that the owner, sorry, let me take this call. Hello? Yes. Good morning. I've started the class. I posted the link yesterday. Chiamaka Vivian, can you hear me? Okay. Two, sorry for the break in transmission. Two is that the business owner are personally liable for all debt and obligation of the business. So whatever debt incurred, whatever obligation, which it could be a lawsuit, it could be anything, they are personally liable for all these liabilities, because the business cannot even be separated from the owner. The owner is the business. So it means that it's liable for all debts and all obligations. Three, business profit are treated as personal income for tax purposes. So business profit is treated as personal income for tax purposes. And this is a very, very key feature, in the sense that When the business ceases upon the owner's death, there is no perpetual succession. That is, the death of the owner is automatically the end of the business. In most cases, the death of the owner is leads to the end of the business. The next is the sole proprietor owns all profits and assets. He owns all profit and assets. The owner can withdraw cash and other liability from the business. So all these, he owns it. So features of someone's business you can do and undo because you are the business. Business is financially through combination of owner's capital because it's the owner that introduced his capital into the business. Next is the sole proprietor owns all profit and assets. The same way the owner can also withdraw cash and other assets from the business. The owner can also decide to employ people. They can decide to employ people typically to play an active role in daily operations. Maybe the person is not too good in financial accounting, he employs an accountant, or the person is a receptionist to receive customers, so he employs all those. But these are a few number of key features of a sole proprietor. So you might be asked to write or to tell us the key features of a sole proprietor. So these are this. That is one, the business are legally the same. That's owner and the business, they are the same. The owner is liable for all debts and liabilities, obligations of the business. The profit of the owner is treated for any of based on PIT, that's personal income tax. The debt of the owner may lead to the business, to the end of the business. The sole proprietor owns all business profits. The owner has rights to withdraw assets. So these are what you are expected to respond when you are being asked what are the key features of our sole proprietor. The next is a partnership. Now, a business partnership is whereby two or more individuals share ownership of a business. That's just the simple term. The share ownership of it. So each partner contributes funds, which we call capital, to establish this business. Now, the key definition is partnership is a relationship that exists between two or more people who have agreed to share profits of a business conducted by them all, or they could be acting on behalf of all the parties. So it's a relationship that coexists between two or more, coming together with the same interest, the same goal to make profit and share them, or to run or acting on behalf of all the partners. Now, in partnership, there must be an association of two or more persons carrying on business. The next is the owners are personally liable for all. So these are one of the key features of partnership. That is, there must be an association of two or more persons to carry on business. Second one is that the owners or the partners, let's put it this way, the partners are personally liable for all of. So the way a sole trader is personally liable for his debts and obligation, now the partners are also liable for their debts and obligation of the business. Now, profit of the partner belongs to the partner and based on an agreed share of profit ratio. But in sole proprietorship business, you see that the profit belongs to the owner because he's the one that injected those profits. And for partnership, it is also treated as personal income tax for tax purposes. So all the partners will be assessed based on the personal income tax. Now, when one partner dies, the partnership may come to an end. It may come to an end. So it's not like it's not certain that so other partners can decide to run or admit another partner. but it might likely come to an end, especially if that partner is one of the key players of the partner. What I mean by key players is the one that has the highest capital contributed. But however, it may come to an end because the partners might decide to go on with the partnership to admit a new partner based on their partnership deeds, which is partnership agreement. Now, the profit and assets of the business also belong to the partner in an agreed sharing ratio. Partners can also withdraw cash and other assets, which is referred to as drawings. Now, the businesses may be financed by partners' capital, including retained earnings or loan. So those are what makes up the key features of partnership. The next is company limited by liability. So a company is a distinct form of a business entity. Nearly all companies in businesses are limited liability company, meaning that the liabilities of their owners is limited by their shares. That's what they mean by limited liability company. It is limited by shares. So in company, ownership and shares. Ownership of a company is represented by its shares. So for you to say I'm an owner of a company, it is determined by the number of shares you have in that company. Two, the number of share issue is dependent on the size of the company. So before you can decide to issue out shares to the public, it is a relationship of size. It depends solely on the size. And a small company must have just one naira ordinary share, while a large company may have millions of shares. So the minimum is one naira and so on to 1 million or more. If a company has 100 shares, an individual holding 40 shares own 40%. So if the total number of shares is made up of 100 shares, it means that an individual holding 40 has 40%, an individual holding 20 has 20%, an individual holding 80 has 80%, and what have you. Large companies typically have numerous shareholders and shares in circulation. As a result, shareholders do not manage the business directly. Instead, executive directors are employed to run the business on the behalf of so in the best interest of the shareholder. So this structure is referred to as a separate ownership from control, whereby the owners entrust the business to somebody to run this business in their behalf, on their behalf, and also in their best interests. In their best interest. Can we all hear me? Good morning.
Yes,
Hello?
sir. I can hear you.
Okay. Another feature is the legal status and liability. Legal status and liability. So unlike businesses, businesses that include the sole trader and partnership, companies are recognized as a legal entity under the law. So it means that Sheyi is different from Sheyi Holdings or Sheyi Company Limited by liability. So Sheyi is a different person. The company is different in the eyes of the law. And that is why they say companies can own its assets, it can enter into contracts, it can be sued, and sue in its own name. So if it is Sheyi that owns maybe 80%, which is a major shareholder, that does not mean if I want to sue the company, I'll go and sue Sheyi. I'll only sue the company because Sheyi is different from the company. You can see that in ownership and control, whereby the shareholders own it, but they now entrust the executive to run it. The next is a company is taxed separately from its owners. So in the contrast of sole trader and partnership, they are taxed on their business profits as income. Here you tax company income tax. A company is solely responsible for its debt. If a company owes 1 million for purchase of goods but cannot make payments, the company itself remains liable, not the shareholder. So it means that the company is owing. It is not the respective shareholders they'll be running after. It is the company that so company is owing. But to sole traders and partnership, you can say Mr. Wale is owing. You can say Mr. Fijabi and Co are owing. But here it is the company that is liable. Then lastly, says shareholders' liability is limited to the amount of capital they have invested, the amount of shares, because that's why it is limited by shares. Their liabilities are limited to the shares they've contributed in the business. Another key features is financial reporting and accountability. Financial reporting and accountability. Now, when a shareholder are not actively managing a business, it is essential for management to regularly report financial information on the company's position and performance. So what are we saying here? We are saying that under this financial reporting and accountability, that is, these shareholders that own this business, they entrust it to the executive directors. It means that this executive director should render stewardship on daily basis or regular intervals. So the shareholders reporting how this company is performing. That is what they mean by accountability. The executive director are held accountable for every transactions that go on in the business, and they report it back to the shareholders. Two, that is, there is a risk that managers may present or mislead financial report to the shareholders. To mitigate these risks, financial reporting and auditing regulations for company are stricter than those for other businesses. So it means that to also ensure financial reporting and accountability is a critical matter. Auditing, statutory audits came about, so that's the essence of checkmating stewardship, checkmating reporting, because yes, you're a shareholder, you employ someone to run your business on your behalf, but that person is a human being. He might not really run it to your own best interest. He might run it to fulfill his own. After all, I was looking for a job and I got this job, so he will run it to his own best interest. And when he's running it to his best interest, it is the duty of the shareholders to employ or ensure that audits are being performed on this report, because management can decide to mislead the shareholders. So the essence of audit is to ensure that the reports are not being misled to the shareholders and to reduce the risks, because the risk of a shareholder, the appetite of risk of a shareholder is different from the appetite of risks of an executive director. What I mean by appetite, the level at which risks can be taken by the shareholder. The management might not want to take it. So those are the basic features of a company limited by liability. So we looked at the sole trader as well as its key features or key characteristics. We looked at partnership as well as its key features and key characteristics with their various meanings. So you might be asked to distinguish between these three businesses: sole trader, partnership, and company. So their features can also even be used to distinguish. For the sole trader, you said all profit belongs to the owner and you'll be assessed for tax through personal income tax. We said all profit for partnership belongs to the partner based on an agreed sharing ratio, and they'll also be accessed for tax through personal income tax. But for company, all the profits belongs to the shareholder, not just it belongs to the shareholders, because at the end they expect returns on their investment, and there will be access to tax distinctly. That is, the business will be access to tax, not the shareholders, and it is based on company income tax. So having understood that, this will take us to advantages and disadvantages of the different types of business entities. So we looked at the sole trader, we looked at partnership, we looked at company. Now, what are the advantages based on headings? So one, it is owned by, for sole trader, one person. For partnership, it's owned by several individuals working together. For company, it's owned by the shareholders. Then their liability for debt and obligation. So these advantages are their key features, as mentioned before. So you can see liability for debt and obligation. For sole trader, he bears both liability and debt. For partnership, they share these liabilities and debt. But for company, it is limited for their shareholders based on their shareholding capacity. So a person that is holding 40%, you don't expect him to carry more than a debt more than what shareholding is holding in the company. A person that holds 80%, you don't expect him to carry the same debts, a 40%. So it is based on their respective shareholdings. Another one is management. For sole trader, it is managed by its owner. For partnership, managed by owners, co-owners. Then for company, they are largely managed by professional managers. So the management is larger. How do they raise capital? Capital for sole trader, it is the individual that introduces his capital. So it is sole trader that provides it most often. For partnership, the capitals are contributed by individual partners. But for companies, it could either be raised by retained earning, or they can either issue funds in the stock market, that's issue to sell, issue their shares out so that people can subscribe to it, and they raise funds. So you can see here that they say the company provides, the capital is provided by the shareholder. Public companies can raise funds from investors in the stock market. So investors can also buy into the company. Unlike other, not that investors cannot buy into it, so a sole trader. They can also buy, but it is limited, because an investor, being a single person, will look at the risks of continuity. If this man dies today, what happens to my investment? Partnership too, if they decide to disagree, or one of the major person that contributes the highest capital decide to say, I'm not even interested, what happens? So they will rather go for a company. But lastly is financial accounting and auditing. So financial accounts is also required for tax purpose. So for a sole trader, he also prepares his financial account for tax purpose, because you'll be access to personal income tax. Partnership, they also will require financial accounting. Financial account is required for the benefit of partners' tax purposes. So then for companies, it is stricter, because it is a statutory requirement that audits should be done annually for most corporate entities, and even limited by liability company, whether PLC or LTD, as the case may be. So after we've looked at business as based on the different forms and their key features, we are now going to what accounting is all about. because every business must have an account, or every business must do accounting. Accounting is a practice, it's a circle, and it's an unending circle that goes on and on and on. Now, what is accounting? So accounting has several definitions, as the case may be. So in defining accounting, there are several definitions. There are several terms that should be found in your definitions. So one of it is that accounting is a systematic and comprehensive recording of financial transactions relating to business, including the process of summarizing, analyzing, reporting these transactions. What do they mean? It's a systematic, it's a process, it is a defined, structured process, and has to do with comprehensive recording. Not that I record one, I leave one. Comprehensive recording of transaction related to the business, not that you bring someone else's activity and record. So it should be related. And in the process of doing this, it must be processed, summarized, analyzed, and lastly, you report this transaction. It can also be a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information to users of this information to make decisions. So what are we saying here? You can see it's a systematic. So it's a process. It's a process is sacrosanct. It is a rule that must be followed. It is a ritual, let me call it that way. So it is a systematic process of identifying. Now you need to start identifying, is this a business transaction? Is this a friendship transaction? So and so on and so forth. Then you need to record. Recording has to do, is this money my coming in? Is this money going out? Then you measure, okay, is it a monetary term? Is it what unit of measurement am I using? Am I using kilogram? Am I using naira? Then you classify. Is this a revenue item? Is this an expenses? Then you verify. Verifying is you check to their source document. Then you also summarize this process, because after doing all these things, you can't just leave it there. You have to summarize it. Then it should be capable of having an interpretation and also communicating this financial information to the users to make decisions. So lastly, accounting involves identifying, measuring, communicating of economic information to enable users make informed decision or economic judgment, as the case be. So any of these definitions are right in case you are asked to define the term what accounting is all about. So financial accounting is the process of recording, classifying, summarizing, presenting financial transactions of an entity in monetary terms. So that's another definition. So you can have several definitions as long as you are mindful of the terms. First, it must first be a process of identifying. It must first be a process. It could be identify, it could be record. So identify, record, measure, classify, verify, summarize, interpret, and communicate this information to enable users to make informed decision. What are the purpose of accounting information? Why do we need this information? So we said it is okay. Why do we need this information? So one of the main purpose of accounting are to maintain records for the business, helping them establish financial control and reduce risks of fraud. So risks of stealing, theft, as the case may be. Two is to assist in managing financial affairs. So it helps in managing financial affairs. Then lastly, it supplies essential information to support decision making. So three main purposes: maintain record, assist in managing financial affairs, and supply essential financial information. Now, accounting information is provided for who? Who needs, to take us to the who needs this financial information, who are the users of financial information. So we have the management, which we can see as the internal users, and we have the external users. The internal users are the management. What do they need this accounting information? So they need this accounting information to equip themselves in running this business efficiently. Those are the internal users, majorly. People that these accounting information are directly connected to, are the internal users. Then the external users are various stakeholders outside the entity relying on your information. And who are they? They include your investors, your lender, your creditors, your government, your employees, general public, and even intended users of the financial reporting. What do they need this? So they might be asked, what do an investor needs the accounting information for? Investor will need the accounting information to invest in the business. So he needs accounting information to invest in the business. What will lender use the information for? They want to know your credit worthiness. If we borrow you this money, can we get, are we sure you'll be able to pay back? What do government need your accounting information to be sure that okay, you can even pay your taxes, or you are even paying your taxes properly? What do employees need this information for? Employees need information that we want to see if we can continue, if the company can continue to pay our salaries. So as the case may be, those are why these people need accounting information. So you can see accounting information is very, very important in all aspects. Even in your daily life, you account for even God in heaven. You have to account for yourself. So accounting is a vital tool for stewardship, for rendering yourself adequately. Is that taken? So we have types of accounting. We have what we call the financial accounting. We have the cost accounting. We have the performance management. We have auditing. We have government accounting. We have taxation, financial management, forensics, environmental, bookkeeping, and so on and so forth. So let's start with the first one. Who are the financial accountants? These ones, they are the ones that prepare. So it involves the process of recording, classifying, preparing, and interpreting financial statements. So it helps both internal and external users to be informed about the financial decision they make. Cost accountants or cost accounting focuses on cost data to provide information as to planning and decision making by the management. Performance, this one helps to show the performer as to whether they are performing or underperforming. So it relates to how efficient, or to monitor and review workforce, or to even compare financial data for 1 year to the next year. So it's help to measure performance. It evaluates results of an entity. Auditing is an independent examination on the financials as to whether the financial gives a true and fair view. So an auditor should be able to form an opinion about the financials prepared as to whether it gives a true and fair view. Government accounting. So this one relates to the public sector. The accounting prepared in the public sector. Taxation, an accounting that reports for how an entity should be taxed, or what are the basis for determining an entity's taxable profit. Financial management. This has to do with management of funds, ensuring that funds are properly utilized efficiently. These scarce funds are properly utilized efficiently in the manner at which they were meant for. Forensics. This has to do with an investigative skill that investigate fraud or a deliberate misrepresentation, misappropriation, or embezzlement within an entity. So social and environmental, this one, we call it triple bottom accounting. It gives an account of the economy, the environment. So that is social accounting. Then bookkeeping. Bookkeeping is just a process of recording financial transactions in an entity's books or an entity's record. Are we there?
Yes.
Okay. So am I too fast?
No, sir.
All right. So let's look at the purpose of financial accounting. What are the purpose of financial accounting? So one of the purpose of financial accounting is to ascertain profit or loss. So basically from here, we said financial accounting refers to maintaining a system of accounting records for business and other financial activity. Two, reporting an entity's financial position, performance through the set of financial statements. So the general purpose of financial accounting is one, to ascertain profit through the profit or loss, or what we call the income statement, and also to show movement of funds within the entity through a book what we call the statement of cash flow, and also to show the financial performance of that entity through the financial position. So it could also be said, what are the objectives of financial accounting? You can say one of the objectives is to ascertain profit, to determine the financial position, to provide information for decision making, and to ensure accountability and stewardship. Accounting systems. Accounting systems. So business entity maintains a system for recording business transaction known as a bookkeeping system. We already said what bookkeeping is, systematic way of recording financial or economic activities in the company's book or record. So all large businesses and even many small ones have bookkeeping system to regularly record their financial transaction. Bookkeeping record of a business are often referred to as accounts. So where you systematically record all activities that has transpired in a business relating to a specific year into their account or their record is what we define as bookkeeping. Now, what is the difference between a bookkeeping? What is the difference between bookkeeping and accounting? Difference between bookkeeping and accounting. One of it is that bookkeeping and accounting are closely related, but they are distinct, however. But bookkeeping is a systematic recording of financial transactions in an organized manner. So what they mean here is, in bookkeeping, you systematically record transactions in an organized manner. So it involves maintaining your ledgers, journals, and financial record. But accounting is a process. Bookkeeping is a systematic way of recording financial transactions, but accounting is the process of identifying or recording, analyzing, summarizing, interpreting this financial reporting, this financial information based on the record kept by the bookkeeper. So the bookkeeper does the first process. He records, post this transaction, you post it, it ends there. But accounting goes beyond just the posting. It identifies, it analyzes, and it reports that financial record that has been posted by the bookkeeper. Two, bookkeeping focus on daily financial transactions such as sales, purchases, received, payments. But accounting includes bookkeeping. Accounting is not just bookkeeping, it includes it, but it extends to even preparing the financials and analyzing performance, tax preparation, and decision making. Bookkeeper focuses just on recording. It ends there. So it records the financial transaction based on sales, purchase, receipt, payments. There's nothing, he wouldn't go further than that. But the accountant goes further than that by using those recordings done by the bookkeeper to prepare financial statements, analyze this financial statement, prepares tax returns, and also make decision based on those informations recorded. 3, bookkeeping ensure accurate record keeping of the financial accounting. They ensure adequate record keeping. Accounting provides an insight, strategic help for decision making and planning. So after you have prepared your adequate record, accounting goes further to give an insight to that record you have prepared for strategic planning. Okay, the sales by the bookkeeper have recorded 100 sales. Accounting goes beyond, okay, if we have recorded 100 sales this year, what can be the forecast for next year? So with that record done by the bookkeeper, an accountant can estimate future sales based on the record done. That is where the financial insight and helps in strategic planning and decision comes. Bookkeeping involves recording transactions, classifying them into account, and maintaining ledger. Accounting involves adjusting entries, preparing financials such as income statement, financial position, cash flow. So you can see most of all these terms are repetitively. Bookkeeper does a part, accounting goes beyond what the bookkeeper does. So if the bookkeeper has classified them into the accounts, let's say this is capital, this is expenditure, the accountant goes further to adjust that entry. Okay, this entry, was it properly done by the book? Because the bookkeeper is a systematic way, it doesn't change. This is how you do it, record it in the respective books. The accounting reviews it and prefer adjusting entries in order to enable preparation of the financial statement, income statement, and even also interpret the financial data by using the ratio analysis and also advising management. So bookkeeping requires basic financial knowledge and attention to details. Accounting requires deeper understanding of financial principles, tax laws, and financial analysis. Bookkeepers do not necessarily make financial decisions, they focus on accurate data. Accounting analyzes financial data and provides reports that assist business owners and managers in decision making. Bookkeeping produces ledger, trial balance, and transaction record. Accounting produces financial statements, budgets, and reports for stakeholders. Bookkeeper may not require formal certification to work within minimal training, but accounting requires the professional qualifications such as an associate chartered accountant, what we are doing now, to become an accountant. So in conclusion, bookkeeping is the foundation of accounting. It focuses on accurate data recording, while accounting interprets, analyze, report financial data to support economic decision. So both functions are essential for the financial health of an organization. If you have any question, you can just drop your message on the chat box, or you can just signify by raising your hands, and I'll see it and I'll pause and ask. So before we go to the roles of accountant and those charged with governance, any question as to what we've looked at? We've looked at business, we've looked at forms of business, we've looked at features of business, we've looked at uh, uh, users of accounting information, purpose of accounting. So any question before I move on? All right. So roles of accountant and those charged with governance. So what comes to our mind when we say roles of accountant and those charged with governance? This is what will come to your mind. Roles of an accountant and those charged with governance. Those that make the strategic decisions are those that ensures supervision of what the accountant does are those charged with governance. So what are the rules of accountants in business? The rules of accountants cannot be overemphasized. One of it is that one of the role of an accountant is to ensure financial reporting, to ensure compliance, to ensure strategy. Accountants provide analysis and insight that contributes to the formulation of business strategy. They also ensure planning. They also ensure control. They also ensure decision making, taxation, and also treasury management. Those are the basic roles of an accountant. The roles of an accountant, as mentioned, can also be the role of an accountant in the economy because they do all these things to ensure that uh, accounting profession is a profession with high esteem. So they can be in different sectors, private sector, government sector, oil and gas, taxation, and whatever sector. So the role of accountant is a very, very crucial role. Roles and duties of those charged with governance. Who are those charged with governance? Those charged with governance are individuals responsible for oversight of the strategic direction of an entity. So they oversee, they are just like the shareholders. They oversee what goes on in the business, ensure that okay, these people that have power is in whose interest is this business run. So they oversee everything. They give power to some people, how they ensure that how this power is used. Are they misusing the power? So those are those charged with um governance. So their roles is to provide an oversight, that's an entire oversight of the and ensure alignment with stakeholders' interests. Is there alignment with the interests of them and those that are running the business on their behalf? So those are the rules of those charged with governance. Financial reporting, participant and their interaction. So they are key participants of financial reporting, more or less like a supply chain. So one of it is management. So management, they ensure the daily operations, daily run of the company, and they ensure that preparation of financial statement reflects the entity's financial true financial performance. We have another people called the audit committee, so they review this financial reporting, ensure that it has integrity in it. We have the directors, they approve the financial statement, ensure that they are fairly presented. We also have the external auditors. They perform an independent audit on the financials to confirm their accuracy, completeness, and compliance with accounting standards. We have the stakeholders. They include investors, creditors, regulators who rely on the financials for decision making. So they are more or less like you can see them as the external users and the internal users combined. And why do they need accounting information? So that's what just played out here. Duties of a director. Directors owe a duty of care to the organization that they govern. So as stated by Kama, what is are the duties of a director? One of it is that the director acts in good faith, in the best interest of the company. The director avoids any conflict of interest. The director exercises independent judgment. He maintains confidentiality of the company's financial information. The director does not accept any benefit from third party, especially competitors, and declare any interest in proposed transactions. Also, the director must declare any interest. So if there's an interest, a conflict of in real life sector, they call it conflict of interest register. So if you are bringing in somebody, you must declare that, okay, I know this person, I don't know this person. So that's how the director should act, as stated by Kama. So the responsibility of the director in relation to the financial statement. One, he ensures that the financial statements are prepared in line with applicable accounting standards. He also ensures that the financials are represented true and fair. He also established appropriate and adequate reporting system. He approves annual budgets and monitors its compliance, whether they are overshooting or undershooting. He liaises with external auditors and ensure quality and independent audit process. He ensures reviews of internal control, ensures checks are put in place. He reviews other information in the annual reports. He also understands and approves assumptions and key judgments in preparing financials. What do you mean by assumptions and key judgments? In process of making provisions. Your debtors are owing you. You want to make provisions for bad debts. Those are assumptions. And lastly, he ensures that the financials are submitted to the regulatory authorities on a timely basis. So in conclusion, those charged in governance, particularly director, plays a vital role for accuracy, transparency, and the integrity of the financial statement. And the directors must take into account the interest of the employees, company, customers, suppliers, whether local or global community where it operates, and its environment, and uphold high standard in areas of conducting and maintaining a strong reputation for the company. Any question at this point? Can I see any hands? Um, okay. So don't be bored. Just listen and you get the information. Why it's like this is like I started the class. Your exams comes in MCQs and theory. So 40 marks MCQs and 60 marks theory. So if you can get all 40 marks MCQ, you've even passed the exams, because the theory might just ask you few questions and or calculate some one or two things, and you are done and with flying colors. So that's why I'm taking my time to read line by line and explain where necessary. The next heading is financial statements. And for us to understand financial statements, we should understand double entering bookkeeping. So in life, double entering is very, very important. That's the basis of financial accounting from now till any stage in life of accounting you want to attain. Double entry. So double entry bookkeeping is used to record transactions in the system that allows business monitor progress and produce periodic financial statements and performance reports. So the information is recorded by the bookkeeper that's using bookkeeping system, which he records into the ledger, and it is from there summarized periodically or typically at the end of each year. This summarized information can be seen, or the accountant now produces what we call the statement of financial position and the statement of profit or loss and other comprehensive income. The objective of this financial reporting is that the financial information about the entity is useful to both existing and potential investors, lenders, and other creditors in making decisions about the resources of the entity. Financial statements relate to specific period of time known as what we call. So they might ask, dash relates to a specific period of time known as what? So you know it's a financial year. So once there is any specific, so financial statements are prepared within a specific period of time known as the financial year, or you call it accounting period or reporting period. So if you write financial year, you are correct. Accounting period, you are correct. Reporting period, you are correct. These statements are prepared from the information contained in the financial record done by the bookkeeper, don't forget, through some adjustment which the accounting person does, and additions needed to complete the financials, especially for company. Financial statements are often referred to as the set of accounts of business. Business entity concepts. So in line with what the bookkeeping is saying, that is, after the bookkeeper has adequately or systematically recorded the transactions in their respective book, the accountant extends that process by making necessary adjustments to summarize all the transactions done to form a set of accounts. And these accounts are prepared over a specific timeline or over a specific period of time, which we call the financial year, the accounting period, or the reporting period. And aside that, there's a concept called business entity concept, which talks about that financial reports are prepared on the basis that the business is separate from its owner. That's what the business entity concept. That's where your accounting concepts and convention comes. The financial accounting is there on the basis that the business is separate from its owner. This principle is known as what we call the business entity concept. So they can just say dash financial reports are prepared on the basis that the business is separate from the entity, from its owner. This principle is known as what? So they'll give you the options, so you know that it's business entity concept. It allows the separation of the business and the owner. So under this concept, the affairs of the business are distinct or distinguished from the personal affairs of the owner. All financial activities of the business are recorded in the accounting period for the company. Let's look at this illustration. They say Iman set up a sole proprietorship as a builder and named the business IK Builders. Now see it. Imran Kalan set up a sole proprietorship. Then he has named the business IK Builders. So by law, if you remember the features of company, I said one of it is their legality. So by law, IK Builders do not have a separate legal personality. Any debts incurred by IK Builders are in fact the personal debt. So remember, this business is a sole proprietorship. However, for the purpose of financial reporting, the business is treated as a separate entity from Imran Khan. So let's take note of those key features of a sole proprietor, a partnership, and a company. Responsibilities for preparing financial statements. the responsibility of a sole trader, there is no formal obligation to prepare financial statements other than for tax purposes. But where required, the owner is responsible. If he requires it, the owner is responsible. So the owner might employ someone to maintain the accounting and prepare the financial statement. For partnership, it's also similar. But here, there might be no formal obligation to prepare the financial statement other than for tax purpose, but where required by the partners collectively responsible. So they might decide to also employ an individual to maintain the accounting record. But for companies are required to prepare financial statements for the shareholders for submission to the relevant regulator, that's CAC, which is annual return, and the one to Federal Inland Revenue, which is the NIRS now, Nigerian Revenue Service. So, any questions? So look at the regulation of financial reporting, which we call the regulatory framework. So there are several regulatory frameworks. We have the generally accepted accounting principle, which is GAAPs. GAAP. So financial reporting is subject to regulations and control to ensure that information presented in the financial statements possesses the required qualities and contents. The concepts, principles, conventions, laws, rules, and regulations are used in preparation and presentation of the financial statements, which are collectively known as generally accepted accounting principles. What are the source of this gap? Because accounting there's a framework that guides its preparation. So this framework, these principles, these concepts, these rules and regulations used in preparing and presenting is known as generally accepted accounting principle. So what makes up the source of this gap? One of it is the common law, which is the CAMA, Company and Allied Matters Act, and two is the accounting standard. Now, gap, there is an issue with gap because it differs from one country to another. Each country has its own legal regulatory framework. For instance, Nigerian gap, US gap, they are different in nature based since their source is company law. So our law is different from the UK law and other laws. Accounting standards. So the profession has developed a wide range of regulations, codes of practice that professional accountants are required to follow. So accounting standards are primarily applied by companies rather than sole trader or partnership, although they are generally written to apply to all type of entity. Nigeria has adopted what we call the IFRS, International Financial Reporting Standard. So they might ask, what is the full meaning of this acronym IFRS? So IFRS is International Financial Reporting Standard. And this IFRS issues what we call the IASB, which is International Accounting Standard Board. So they might also ask you what is the acronym of IASB. So it is International Accounting Standard Board. Accounting standard provides guidance for 4 areas. And I ask, what are the areas accounting standard provide guidance for? So we have it to be recognition, measurement, presentation, and disclosure. DPRM. DPRM. Disclosure, presentation, recognition, measurements. DPRM. What is recognition? Recognition, when should an item be included in the financial statements? At one point, that's recognition. Measurements has to do with value. The value at which the item should be recorded. Presentation, the structure and format of the financial statement. How is this item displayed at its presentation? Then disclosure, are there any other additional information that must be provided to help users of this financial understand the financial performance or position of the entity properly. So don't forget, these are the 4 areas. Other regulation includes the Financial Reporting Council of Nigeria, FRCN. They might ask you what's for me on FRCN. So in addition to the GAP and international standard, that's GAP and IFRS in Nigeria, Nigeria is also governed by other national regulation, which include the Hearing of Finance Act of 2019, 2020. I think there is also the latest should be 2021. Yes, Finance Act. So this act are part of what the government and Nigerian tax policy reforms aims at improving financial management. And also, they address some economic challenges brought about by COVID-19. So there are other, this Finance Act has also made amendments to your capital gain tax, your CIT, that's Company Income Tax Act, your Industrial Development Tax Relief, personal income tax, your educational tax. There's no more educational tax now. It's now development levy, which is 4%. Your custom and excise duty, your value added tax, your stamp duty, your Federal Land Revenue Service Act, your Nigerian Export Processing Zone, oil and gas, company and allied matters, physical responsibilities, and other procurement acts. So these are addendum to the regulations that underpins the preparation of financial statement. So there are certain requirements or key highlights to Company and Allied Matters Act to preparation of financial statement to ensure that it meets global best practice. One of the highlights is that there should be mandatory audits. There should be sanctioning for defaulting directors. There should be an oversight. There should be procedures convening annual and extraordinary general meetings. There should be guidelines for prudent management of shareholders' assets. There should be rule on ownership transfer of shareholders' rights. There should also be a secured system for shares, registration, votes, and proxies. There should be an enhanced protection for minority shareholders. That's the one key highlights to Company and Allied Matters Act. Mandatory audits, there should be sanctioning, there should be oversights, there should be a procedure for conducting annual AGMs, there should be guidelines for prudent management assets, there should be rules as relate to ownership and transfers, there should be secured system for shares registration, voting, and proxies, and also there should be protection of minority share. So as other highlights for that's the FRCN, that's Financial Reporting Council Act 2023. So the act is responsible for, what is it responsible for? Developing and publishing accounting and reporting standards for PIEs, that's companies listed in the stock exchange. We call them PIEs, public listed entities. Reviewing and promoting and enforcing compliance of the standard. That is, the standard sets. They also review, they also promote, they also ensure compliance. So you might be asked, what are the responsibility of FRC? So one is to develop and publish financial statements. Develop standards, that's financial reporting standard for PIEs. Two, to review, to promote and enforce compliance with this standard. Three, to receive notification for non-compliance from preparers, users, even auditors or third party. Four, to receive copies of annual reports of PIEs, that's public listed entities, within 60 days of the board approval, and so on. So those are the four. They are more than it. They also ensure sanction. They also ensure delisting of members. So yeah. Basis of accounting. Now, having understood what accounting is, the regulatory framework of accounting, we should now know, and the period which accounting are prepared, we should now know on what basis are these accounting prepared. So there are three main bases that determines how transactions are recognized and measured in the financial statements. One of it is what we call the accrual basis. Accrual basis. The other one is called the cash basis. The cash basis. And lastly, the last one is called the breakup basis. So accounting is prepared, or accounting transactions are prepared based on these three bases, whether accrual, cash base, and breakup. So in practice, accrual basis is far more widely used and important of the three. What is accrual basis? Accrual basis of accounting is more or less like matching concept. However, accrual basis of accounting also refers to as accrual accounting, means that what are they saying? They say recognition of transactions and other events in the period which they occur, regardless of when the cash flow happens. This method provides an accurate picture of a business performance and position. So what is this principle, or what is this basis all about? He said, irrespective of whether cash is paid, transactions should be recorded as long as those transactions are being incurred, or they are aimed. So irrespective of whether cash is made, as long as that transaction has been aimed, you should record the transaction. So it means that if Mr. Jala comes and say, I want to do business with Mr. Tony, and tells Mr. Tony that I want to do a 50 million naira business. However, I'm not giving you the 50 million naira now. I will give you later. And they've signed the agreement. What he's saying is that record that 50 million in your book as your revenue, irrespective of whether cash has been collected. That's where they say recognize transactions and other events in the period in which they occur, regardless of whether a related cash flow happen. So this provides a more accurate picture of the business. Key features of accrual basis include revenue from sales and other income should be recognized in the period which it is aimed. So it means that if Mr. Jala comes, maybe Mr. Jala comes at January, 50 million transaction, you record this 50 million for the full year, right? But maybe it comes like around September. It means that you cannot recognize all the full amount in that September. You have to prorate it. So that's what they mean by revenues from sales and other income should be recognized in the period which it is aimed, even if the cash is not received in the period. Now, for cost of sales, they say the cost of sales must be matched with the related revenue in the same period. So for that revenue I've recorded, if there's any expenses incurred, it should be matched to that period. You cannot take another period expenses to match it there. So that's where the matching concept comes. Said the cost of sales must be matched with the related revenue in the same accounting period. This ensures that the income and the corresponding expenses are reported together, getting a true picture of the profitability for that period. Other expenses should be recorded in the period to which it relates, not necessarily when cash are paid. Don't forget, all financials are prepared based on a timeline, are prepared based on a period. Accounting periods, accounting basis. So that is accrual concept. Would let's quickly explain this example from what we have said. We said a company prepares its financials to 31st December. On 6th December, year 2, it sells goods worth 50 million to a customer, but did not receive payment until January the third year. It sells but did not receive payment until January the third year. So under the accrual basis, what are they saying? Under the accrual basis, the sales should recognize as an income in the financial year ending December year 2. Have you heard? Even if cash was not received, this is because the income was earned in year 2, not necessarily when payment was received. Another one is, they said a company starts a business on 1st September year 1. It pays office rent in advance, covering the period to August year 2. So it means that from September year 1 to August year 2 is 1 year. So if you count September, October, November, December, January, February, March, April, May, June, July, August, 1 year. They now told us that the total rent is 120. The company prepares its financials to 31st December. Now, when was this transaction aimed? That would be the first question. So having understood when the transaction has been aimed, it means that if the company starts September year 1, so it means that the expenses, we can't recognize this whole expenses in year 1. That's the 120,000. However, we only record a portion of the expenses in year 1, which is from September to December. So September, October, November, December, 4 months. So 4 months, 4 over 12 times 120,000 would be the expenses that will be recorded in year 1, while the remaining will be taken to year 2. Is that taken? Is that taken?
Yes, sir. Yes, sir.
We understood what I said, Abby.
Yes.
What did I say? Somebody. Chidima, you can speak. Hmm?
Hello.
Yes, you can speak.
Can you hear me, sir?
Yes, I'm hearing you.
Okay. Based on the accrual concept,
Yes.
it's only the 4 months that is related to that of year 1 that will be captured in year 1. The remaining one will be
Exactly.
represented in year 2.
Exactly. Thank you so much for following. Any other person? Hope you are not lost because we are going deeper. Okay. Thank you so much for your feedback. So let's continue. So now ICAN furtherly tells us what accrual expense is all about. Definition. They said accrual or accrued expense is a liability representing the amount of an entity owed for goods and services received during a financial period, but for which no invoice has been received. So what are they saying? Accrual expenses is an expense that has been incurred, right? But now cash has not been paid on that expense, so you can accrue for that expenses. That's what this English is saying. That accrual expense is a liability that represents the amount owed for goods or services received during a financial period, but has not been invoiced. That is, invoice means that it has not been paid. Because if you buy goods from somebody, I don't issue out invoice for payment. That's what they mean here, that for which no invoice is yet to be received. We also have what we call prepayment. The prepayment is an advance amount paid in advance for goods and services that will be received in future accounting period. So there's accrual and there's prepayment. There's accrual and there's prepayment. Accruals are liability, prepayment, and asset, because this one they've paid in advance. Like rent now, you pay your rent in advance and enjoy. So a prepayment made in year one for an expense that relate to year two should not be recognized as an expense in year one. Instead, it should be carried forward as a current asset and charged as an expenses in year two, when the related benefit is actually received. What are they saying here? So if you made a payment in advance, a prepaid expenses in advance, that's you have paid ahead, you cannot recognize it as an expense in year one. Instead, what the rule says is that you first carry it forward as a current asset, because it's an asset to you. Then charge it as an expense in the period it relates, which is that year two, because that is when benefits is actually received. Let's see this. They say company rent is space at a cost of 6 million per year, payable 12 months in arrears. That's payments made at the end of the year. The first payment is due in June. The company prepares its financials to 31st December each year. So under accrual basis, what would you do? Anybody? Under accrual basis, you first do the first 6 months, right? For year one. True or false? True. So you first do the first 6 months under accrual basis, which you see here that although the company will not receive this invoice by the end of 31st December, but it has occupied the office for the first 6 months. So in year one, so under the accrual basis, 3 million will be charged expense to profit or loss. The corresponding liability will be 3 million. What I said initially. But under prepayments, if it is prepaid, they paid it, it means that you can only recognize this 6 million as a current asset. And in that period it relates, which is year two, you now recognize the 6 million as an expense. Is that taken? This chapter will be dealt with in later chapters, so let's just have a background of how it works. Cash basis. They said cash basis recognized from the word cash basis, you should know. Cash basis recognizes transaction in the period which its related cash, receipts, and payment occurs. So in cash basis, what we are saying is that you only recognize an item of expenditure or an item of receipt when cash is received or paid. So when it is received, you recognize as a receipt. When it is paid, you recognize as an expense. So we are now saying revenue from sales and other income is recorded in the period when cash is received, which may be later than the period in which the income was in. So anytime the person pays, that's when you recognize that payment. If the person did not pay under cash basis, you are not recognizing anything. So expenses are recognized in the period in which they are paid and not when they are incurred. So a company prepares its accounts to 31st December. It sold goods to customer on 6, but did not receive a cash payment until 15th January year 3. What are they saying? Under the accrual, you first recognize a portion. And if you look at it, January, when was it sold to this? So to the customer January 6. So under the cash basis, you will not recognize anything, but you recognize the 50,000 naira when the cash was received in year 3. But in Accura, you recognize 1 month own for year 2, then the remaining goes to year 3. But here, you just recognize when the cash was paid, which is year 3. So you can see that Accrual is recognized as an income in year 2, even though the cash is not received until the end of the year. But in cash basis, you can recognize it straight in year 3 because that's when cash was received. So revenue is recognized as an income under both bases, but different periods. So you can see Accrual as recognized when it was incurred. But cash basis, it's not when it was incurred, though. It's when cash was paid for it to recognize. So you can see Accrual recognized in year 2. Cash based recognized when the cash was paid in year 3. So we can just go through these exercises. They are not difficult based on the explanation provided. Breakup basis of accounting. Under the breakup basis, they say both accruals and cash basis assume that the business is going to continue into the unforeseeable future. That is, the business has no intentions to terminate. But however, this might not be the case under breakup. So in breakup, a business might be brought to an end because the owners have decided that the business has run its own course. So they might decide to break up. So in breakup basis is used when the business is no longer a going concern. Under this basis, all asset and liability must be measured. Sorry. Hello? Yes. Yes. Sorry. Under the breakup, the accounting is used when the business is no longer a going concern. All assets and liabilities are measured at the amount of cash they can be sold for, which is the realizable value. So cash will be sold, liabilities would be settled. Here now, they say a company prepares its financials to 31st December each year. The company is in a severe financial difficulties and is not expected to survive. It had a building carried at 1.5. Real estate professionals have advised that the building can be sold at 1.2 in the current market condition. So in this case now, under the breakup basis, what will be the value of the building will be 1.2, which is the market realizable value or the net realizable value, not the carrying amount of the asset of 1.5. That is what breakup is saying. That is, when the business is about to come to an end, the assets will be sold off, the liabilities will be settled, and the assets that will be sold off will be based, what will be recognized in the face of the financials would be the net realizable value. That's the amount at which that asset can be bought in the market. That is breakup. Then we have the last one, modified cash basis. It has the features of both accruals and cash. So under the modified cash basis, it may be merged together to form modified cash basis. Revenue and expenses are recognized as cash is received and disbursed with the exception of large cash outflow for long-lived asset, which is recorded as an asset and depreciated over time. So what modified cash basis talking about is just an advance of cash basis. But however, it it's it also recognizes accrual, some portion of accrual and some portion of cash. That's what a modified cash basis. But it looks at it from large cash flow perspective. If the cash flow or the payment is large, it won't recognize. So it will just say, okay, I know this person in my pay, so let's just recognize it. So we call it modified because it has both features of accrual and cash basis. So need of those who need financial information. We've discussed this. So this is the note about it. Investors. Why do investors need financial information? Investors in business that provide risk capital, unless they are managers as well as owners, they invest to obtain financial return on their investment. So they need um, financial information to obtain certain information for them to make investments, and for them to also ascertain that we are going to get a financial return. Lenders, why do they need? Lenders such as banks are interested in financial information about the business so that if they can borrow them money. Remember, I said this when we started the class. Suppliers and trade union, they need financial information because they want to see if they can continue to provide goods on credit to the business. Our government, why do they need this financial? They want to see whether the information used by the business relates, they can use it to determine their tax and policies. Can the business pay this tax? This policy we are changing about tax. The public, the public need financial information to make substantial contribution locally. Like the public needs financial information to even know that, okay, this company is even really existing. This company can exist into the foreseeable future. This company can even employ our people. That is why they need this accounting information. Employee, why do they need an accounting information? For job stability. They want to know that the company is constantly making profit and will continue to make profit. Customers, why do they need this financial information? To have interest in the financial strength, especially to rely on long-term supply of key goods and services. So managers, why do they need financial information? Managers are not typically included in the list by IASB, that's International Accounting Standard Board Framework, because they have access to all financial information they need often, and much rely detailed than, so their own is even more detailed because they are internal users of the financial information they provide. However, management is responsible for providing this financial and may still be interested in the financial information contained in them. What are the components of financial statement? When they say components, just like if they say what is the component of a man, a skeleton. So what are the components of a financial statement? So a few set of financial statements should include the following: statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flow, and notes to the account. These are the components of financial statements. You should know it at every point. So, however, these components will be discussed one by one in later chapters. The statement of financial position. So before, we used to call it balance sheet. So it reports the position of an entity as at a particular date. It represents the entity's assets, liabilities, and equity. Now, what is an asset? So they might now ask you, what are the elements of financial statements? You know, you have components, you have elements. Now, the elements of the financial statement are the bones that makes up the skeleton for human. So in financial, what makes up the financial statement? It is assets, liability, expense, income, and equity. We'll get there. I think we are here already. So assets, prior to now, we say assets are what you own. But with the adoption of IFRS, assets are now resources that an entity owns, control, or is owed. Why this is not a technical definition, it serves as the basis for explanation for now. A more detailed explanation will be provided in the next chapter. So we'll be looking at elements of financial statement in full in the subsequent chapters. So assets are classified in the financials under two categories. current assets. So current assets are those ones expected that the economic benefits would flow for more less than within 1 year. So it's the economic benefits expected to flow within 1 year. It's not supposed to span over more than 1 year. That is current asset. Then we also have what we call non-current assets, which we call our fixed assets before. So non-current assets are those that the economic benefits can flow over a period of time, which is more than 1 year. We also have liabilities. Liabilities are also broken down into current liabilities and non-current. So liabilities are amounts payable. Current ones are those ones that the amount are payable by the company within 12 months or within 1 year or not more than 1 year. But non-current are those ones payable within the next 12 months. As they are payable by the company for more than 1 year. Equity. What is equity? We used to call equity capital. So equity is the residual interest in the business that belongs to its owners after all liabilities has been deducted from the asset. So equity is just residual interest after you have deducted assets. Your total asset minus your current liability gives you the owner's equity. Accounting equation. What is the accounting equation? Accounting equation is asset minus liability equals equity, or asset is equals to liability plus equity, whichever the case is. So FRS has improved the definition that even when I go to borrow money to start a business, it's a capital, it's an asset. When the money is my money, it is my asset and it's also capital. So it has so modified the whole scenario to fit in current reality. So the statement of financial position provides detailed representation of this equation. Format of the financial statement. So the statement of financial position is divided into two sections. Upper sections, which shows the assets of the business, beginning with non-current assets, followed by current assets. The lower section shows the equity, followed by liabilities, non-current liabilities, which are long-time liabilities, and then current liabilities. So you see something like this. Is that taking? So assets, non-current assets, land, plant and equipment, motor vehicle, current assets, inventory, receivable, cash, total assets, this. Equities. Sorry, give me a moment, please. So, sorry. So we have equities, liabilities. Equities and liabilities. Under equities, we have the owner's capital. Under equity, we also have non-current liabilities, which is long-time bank loan. Then we also have current liability, bank overdraft, which the bank overdraft is within a year. Trade payables is within a year, and everything should be equal. Total assets should be equal to total equities and liabilities. Ooh. So for the profit or loss, another comprehensive income. So this one provides financial performance of an entity over a specific period of time, and it comprises of two parts too. Statement of profit or loss, which lists income and expenses resulting in profit or loss for the period, and also statement of other comprehensive income. This include other gains and losses that arises during the period. We also have income. What makes up income? Income includes revenue from sales of goods or service, other income such as interest received from investment, gain of from disposing non-current assets for more than their carrying amounts. That's if you have gain on disposing non-current assets. What they mean here is if a machine is sold for 15 naira and the carrying amount is 10 naira, the gain on disposal is what? 5,000, because this is what is shown in the financials, 10,000 naira. This is what they mean by carrying amount is in what we call the net book value before. So the net book value in your state of financials is 10,000. But when someone came to price the machine is now costing 15,000. So it means that this is the disposal of a non-current asset for more than its carrying amount. So you can see the sales of it is more than the carrying amount, which equals 5,000 naira. So in the financial reporting, the term is revenue, specifically to income aimed in the normal course of business operation. Expenses. So expenses consist of expenses arising in the ordinary course of business, including cost of sales, wages and salary, the cost of depletion, that's depreciation of current assets, interest payable on loan, and so on. Even loss arising from disasters such as fire, flood, are losses, and also losses from even disposal of current assets for less than its carrying amount. Same example, if here was now 15,000 naira and here was 10,000 naira, it would be a loss of 5,000 naira. Format for a simple profit or loss. So the order of presentation is usually your revenue, which is your sales. Prior to now, we call it turnover. Your cost of sales, your gross profit, which is revenue minus cost of sales, your other income, your other expenses, and so your other expenses, which will be itemized in detail when we are solving. Your net profit, which is your other expenses minus your gross profit plus other income minus this will give you your net profit, which is gross profits plus other income minus other expenses will give you net profit. Then you tax charge, which will be representing the tax payable on profit. So you can see this illustration: revenue 800, cost of sales 500, gross profits, other income gain 310, other expenses 270, net profit. Then when you charge tax of 30% on this, you have your tax payable. So gross profit is the sales revenue minus the cost of sales in a period. Net profit is the profit after taking into account other income and other expenses for the period. So relationship between a statement of profit or loss and other comprehensive income. So the statement of financial position shows the equity of business at a point in time. In practice, the balances from the previous year are always also included. This is known as comparative figure. That's in practice. So, for example, this is what they are saying. Lagos Shipping statement of financial position as at 2019. So it means that the comparative will be 2018. So if it was 2018, the comparative will be 2017. If it is 2020, the comparative will be 2019. So you can see the comparative period. It's to be 575. Now it's now 580. It used to be 25%. So you can see the comparative period. Also for changes in equity and net assets, you can see a comparative period. So the next subhead is business transaction. We said the business has to do with an economic system that has to do with the exchange of goods, services for a consideration, which is normally money. Now, business transactions is an interaction between a business and a customer, supplier, or other parties with whom that does business. It is an economic event that must be recorded in business accounting system. So there are many types of business transactions. So it could be cash sales from goods or services, it could be credit sales, it could be receipts from customers whom a sale on credit has been made. It could be cash purchase of raw materials. It could be credit purchase of raw materials. It could be payment to suppliers for who credit purchase was made. It could also even be received from loan proceed. It could be repayment of loan. It could be payment to employees. It could be payments made to government, which are in form of taxes. It could be purchase of non-current assets, and there are many more business transactions. But however, business transactions can be classified into a number of categories, which is not subject to these only. But for the purpose of the syllabus, we would classify based on simple transactions and complex transactions, one-off transactions and ongoing transactions, capital transactions, and revenue transactions. What are simple or complex transactions? From the word simple or complex transactions, what do they mean? Simple transactions, complex transaction. I go, I buy phone. It's a simple transaction. Now, if I don't decide to buy the phone in bulk, maybe I want to resell, it now becomes a complex transaction. So what are we saying here? Say many transactions involve simple exchange. For example, a sale of Samsung phone by a retailer to a customer for a cash is a simple transaction. But if the same is made on credit, where the customer does not pay immediately, it becomes a more complex transaction. In this case, it might involve series of payments and some of the amount received might constitute interest. So it becomes a complex transaction. Two, one of or an ongoing transaction. One of, I just go, I buy that. It's not that it's something I buy frequently. It's a one-off transaction. Ongoing is something I buy frequently. From here now, they said many transactions may occur on a single occasion. However, there are some relationships which will lead to series of transactions of an ongoing nature. For example, a person buying Samsung Galaxy will need a contract with a mobile network. The contract would involve series of commitments by each party as a result of series of payments by the owner of the phone network provider in return for the provision of services. One of the most important ongoing relationship is that between a person or a business and a bank. This may last for many years and involves the provision of series of different services through a whole series of transactions. So an internet company now, you might get the internet facilities, you might get the router, the installation, and that is one of. But now you continue to subscribing, it becomes a continuous trend. So you make provision to subscribe to data, maybe monthly, yearly, annual, biannually, and so on. So it becomes an ongoing transaction. You go to the bank, you open an account, one off. Now you servicing that bank becomes an ongoing transaction. The next is capital and revenue transactions. A business entity typically operates over many years but prepare financial statement annually at the end of the year, incurs expenditure for long-term purpose such as investing in machineries, equipment, non-current assets, short-term needs such as paying for suppliers, services, and employee wages. That same business can also generate income from its operating activities and may receive funds from other sources such as bank loan, capital contribution from the owner. Now, there's a clear distinction between these two now. For capital items are of long-term nature. This includes property, that's PPE, property, plant, and equipment that are used in the ongoing operation of the business. For revenue items, they are short-term in nature and they relate to normal cycle of business operation, such as daily expenses and income from regular trading activities. As a general, though not strict accurate guide. So for capital items are reported in the statement of financial position as they provide a long economic benefit. Revenue are reported as income and expenses in the profit or loss and other comprehensive, reflecting their impact within the financial year. So you can see for capital and revenue transactions, we said capital for 1 year, revenue within that period, that financial period, which is normally 1 year. We also have capital and revenue expenditure. Now, capital expenditure refers to as when you hear capital expenditure, it has to do with you are trying to acquire or improve a long-term assets, and you are going to use this asset to span beyond 1 year. Examples of this is property, plant and equipment, office furniture, motor vehicle. Installation costs associated with new assets, improvement or addition of existing assets, building extension, installation of air conditioning. So any expenses that will expand beyond a period of 1 year is denoted as what we call a capital expenditure. Fees paid to raise long-term finance is also capital expenditure. A capital asset is also referred to as a non-current asset in accordance to International Accounting Standard Board. Capitalization means recognizing a cost as an asset or a part of that cost as an asset. So they can just say capitalize. If they say capitalize an item, it means recognize that item as an asset. Are you getting what I'm saying? Capitalize that item as an asset. Make that item, treat that item as an asset rather than expenses. Revenue expenditure. So all this one refers to if the capital expenditure is spanned beyond 1 year. Revenue expenditure are those that can be said it does not expand 1 year, but within 1 year, or spendings on day-to-day running cost of the business. For example, purchase of goods for resale, purchase of raw material for manufacturing goods, operating expenses such as rent, electricity, wages, repairs and maintenance of non-current assets, distribution cost, cost of advertisement, administrative costs such as accounting service, license fees, and office supplies. These are what we call capital, revenue expenditure. We also have what we call revenue income and capital receipts. Now, revenue income, these are income generated in the normal course of business operation from investment. I invest something, I get revenue. I buy shares, I get dividend, revenue income. So examples: revenue from sales of goods, commission received or receivable, interest received or receivable from savings, rent received or receivable from letting a property. These are revenue income. Revenue is reported in the financial statements within statement or loss within the statement of comprehensive income. Capital receipt refers to capital receipt refers to a long-term income, such as money from loans or new money invested into the business, referred to as capital. Capital receipt affects the financial position of an entity, but does not affect the financial performance. Financial performance is the one within 1 year and which will be shown in the statement of profit or loss and other comprehensive income. Therefore, capital receipts are excluded from the statement of comprehensive income. Don't forget, capital receipts are excluded from the statement of comprehensive income. You only include revenue receipts, revenue income. So a business borrows 100,000 from a bank for 5 years and repays interest of 8,000 on the loan for the first year. So first, you see that 100,000 is a non-current liability because it's for more than 5 years, right? What we said before. But you see the 8K that is paying, it's going to be an expenses, which will be expense in the period it relates. So it qualifies as a revenue expenditure, right? Now, a business has two identical vehicles, both with engine problems. Has two identical vehicles, both with engine problem. The engine of one is repaired. Now, if they say the engine of one is repaired, repairing is not a capital expenditure, if you remember. So it's a revenue expenditure. So it is associated with repair. But the second one, they said it was replaced. This is now a capital expenditure because that replacement, as it is a capital project, it will span beyond 1 year. But this engine one, since it got repaired, it can still spoil again. So that will be treated as a revenue expenditure, but the replacements will be treated as a capital expenditure. Why I'm taking my time to break it down this way, because you might also be asked, they'll give you items, classify these items according to these different headings. So you need to understand the various terminology, the one within 1 year, the one for more than 1 year. Is it a capital revenue expenditure? Is it a capital expenditure? Is it a revenue receipt? Is it a capital receipt? All those things you need to bear in mind when classifying those items. So, what are the ethical considerations for preparation of financial statements? So, there are certain things. What is ethics? Ethics basically is a principle of moral that has to do with right and wrong. Now, there are certain considerations you need to take into place when preparing financial statement. The need for professional ethics in financial reporting. Professional accountants are faced with several ethical pressures and influence from their employees, clients, executives, and politicians. Their responsibilities extend beyond satisfying clients or employer to acting in public interest. So, as an accountant, you are not acting in anybody's interest, but you are acting in the public interests. So, an important of ethical behavior. Financial reports are essential for decision making by shareholders, creditors, so other stakeholders that need this financial. Accountant must provide or produce a report based on these fundamental qualities. One, honesty. Two, integrity. Three, transparency and accountability. So an accountant's behavior in preparing financial, you must prepare the financial based on all honesty, all integrity, all transparency, and all accountability. Now, ethics and code of conduct for professional. However, ICAN has provided us code of ethics for accountant, which includes one, integrity. What does integrity mean? Professional accountants must be honest and straightforward in their dealings. That is integrity. It means that honesty, fair dealings, and truthfulness should be seen or applied in all facets of a professional accountant life. Objectivity. A professional accountant should be objective in the sense that members should not be biased, should not have conflict of interest, should not be subjected under undue influence to override professional judgment. You should exhibit professional competence and due care. Members should maintain their professional knowledge, skills to provide competent service. So objectivity has to do with you standing to what is right. You are not biased. You are not easily influenced by people's opinion. You are objective. Your yay is yay and your nay is nay. Professional behavior. Professional behavior, a member should comply with the laws and regulations, behave with courtesy, and avoid actions that will bring disrepute to the organization. That is professional behavior. Bearing in mind professional due care when discharging your duty. It is professional behavior. And a professional accountant should not be seen behaving anyhow. Anything that will cause disrepute to the profession. A professional accountant should not be found in such capacity. Lastly, confidentiality. You must not disclose client information. Now, except that information, the only way you can disclose the client information, that's all professional accountants should maintain confidentiality in their dealings. The only way those confidentiality will be broken is when the client has given you permission to disclose, when it is required by law, and when it will be of a greater good to the public, then confidentiality can be broken. Like I said, one, when it is required by law. Two, when the client gives you permission to disclose, and when that information you are going, that information you are going to give will be of better good to the public. Remember, I said accountant should not act in other person's interest, even in his own interest, but the interest you are protecting is the public's interest. Type of manipulations in the financial statement. So there are different kinds of manipulations in the financial. So one of it is misrepresentation of liability. You misrepresent the liability, which include omitting liability from the financial statement, misclassifying liability as equity, treating preference share as equity instead of debt instrument. This can increase net assets, reduce gearing, avoid breaching debt covenant. So these are misrepresentation of liability. When you totally omit the liability, when you misclassify the liability, or when you treat some equity components, you treat preference share as equity of a debt instrument. That is mispresentation of a liability. Revenue manipulation. You understate revenue to reduce tax. You recognize fictitious revenue to attract investors. You raise invoice before the end of the accounting period to inflate sales figures. You record loan proceeds as revenue. So those are revenue manipulation. We also have depreciation manipulations. Setting arbitrary depreciation rates or method. That's why capital allowance is there. And that's the reason for deferred tax. Don't worry, we'll get there. So increasing the useful life of the others, the scrap value, which is the salvage value of the depreciable asset, extending the useful life of the asset is also depreciation manipulation. Asset manipulation, arbitrarily really revaluing non-current assets to reduce debt to equity ratio. That's you revalue asset that you know that as write off that is now zero, or the asset that you know that the carrying amount is equal to zero, you now put 15 million there because you want to reduce debt to equity ratio. Selling off under depreciated assets to aid one-off gain. Assets that are not fully depreciated, you try to sell it because you want it. We also have expenses manipulation, capitalizing operation costs. That's making a operating cost to be an asset. That's capitalization. Failing to recognize impairment loss or written down of inventory to their net realizable value. When we get to IS2, we'll deal more of inventory, and also IS 36 will deal more with impairment losses. Even disclosure manipulation, inadequate disclosure, failure to write off doubtful receivables, that's doubtful debts, to avoid reporting losses. So what motivates these unethical practices? One of it, you know that it is when there is personal interest, personal gain. Maybe there is market pressure. The market indicates a boost of market capitalization to attract investor. You want investor, you want investor. That is one of why we practice this unethical practice. Tax benefits. We want to pay the actual tax. We want to reduce our tax liability. Then even concealment of misdeed, covering up assets misappropriated by employees, concealing material losses in the financials. Those are concealment of misdeed. Something bad happened. You are trying to cover it up instead of telling the shareholders, those in charge of governance. Then finally, we have lack of internal control when checks are not put in place to safeguard companies' assets. So we also have threats to compliance with ethical behavior. But before we can see those threats to compliance, we need to understand what are the types of threats that might affect a professional accountant. So threats are anything that can induce a professional behavior, anything that can affect, anything that can influence you from being objective, from maintaining independence, from ensuring professional behavior, from maintaining confidentiality. Those are threats. So one of it is self-interest threats. Now, where the professional accountant has personal interests, or his close families are there, he has personal interests. That's the threat. That's self-interest. We also have self-review threats. When a professional accountant reviews his own work, for example, you're working with one and co before, or you're working with a company. You're just preparing the account anyhow because nobody was monitoring you. And fortunately for you, you now got the offer in Big Four. Unlucky for you, Big Four now got the engagement, and you are now the team lead. You now went there to review what you have prepared. Would you say anything? You wouldn't say. So that is self-review. Preparing financials for a client and then conducting audit. It's also self-review. Reviewing one's own tax return or financial planning advice. Advising yourself. So that's self-review. Advocacy. Advocacy share occurs when an accountant promotes a client view, potentially impairing his own objectivity. Example, acting as professional weakness in a legal. So you are not supposed to even act as a weakness in a legal dispute. Promoting a client interest in negotiating business transactions. You're not supposed to do that. That is what we call advocacy threat. Familiarity threats. This one arises from long and close relationship with clients, which may lead the accountant becoming so sympathetic to the client's point of view. And compromise comes, objectivity comes, compromise of objectivity and independence comes. Intimidation threat. This threat occurs when the professional's objectivity and independence is compromised by a real passive pressure. Your boss, your superior, go and change that figure to 2 million because you're an investor. You go change it. You don't have, or I will sack you. So those are intimidation threats. Now, how do we resolve these ethical conflicts? So there are various steps an accountant should follow. One, states the fact. The fact means gather the information. What is the basic info? What is the basic thing? What is the basic challenge you're facing? Two, apply fundamental principles. That's apply principles relating to the matter. So what threats is it? What threats is it impairing? Is it your integrity? Is it your objectivity? Is it your transparency? Then you explain based on your general accepted accounting principle. What are the consequences for this unethical approach? Establish an internal procedures, develop procedures to resolve issues internally, explore other alternatives. That's if the internal procedure fail, explore other course of actions. Consult governing board or audit committee to seek guidance. Document your issue. Remember, documentation is very, very key. Anything you fail to document, then you've not done. Seek external advice. You would consult people that are in practice higher than you. Then lastly, if you see that all these fail, then it is best you consider disengaging from such assignment by resigning. So what are the consequences for this unethical financial reporting? One, the investor lose confidence. You lose confidence, low participation in your stock market or substantial fall in your stock price. It could also lead to lawsuits because it misled people. So the creditors might file lawsuits. Doubt about integrity of the financials, going concern threats, depressed economic climate. That's widespread of unethical practice can impact the economy. The higher capital cost. Unethical reporting can increase the cost of obtaining capital. That's because the banks now want to see your financials. How would you get capital? So, what are the measures put in place to ensure quality reporting? One is the conceptual framework, which is the IASB. It provides guidance for DPMR, disclosure, presentation, recognition, and measurement. Two, principle-based accounting. Three, professional accounting codes of ethics, then also company codes of ethics. At this junction, any question? So I'll leave the class with these these are summary from the class, review their questions and answers and also practice question. So the class can just quickly practice this. Please don't look at the answer, practice it. Anywhere you have stopped, we'll do it in the next class. So next week will be quite very fast. I was supposed to do both chapter 1 and 2 today, but let me not bug you with so much information. So I'll leave you at this point. We'll see next week. I'll be looking at the ISB conceptual framework for financial reporting. Any question at this point? Class, any question at this point? Some people are joining, some people are leaving. Viv, any question?
From me, no. I'll still have to go through the class. And if
Okay.
any comes up, I'll let you know, sir.
All
Thank
right.
you.
Thank you. Thank you so much. Lois, any question? Okay. So in the absence of none, see you next class.
Thank you, sir.
Thank you.